What is the 1040? What are above the line deductions? What are below the line deductions? What are qualified charitable distributions? Can self-employed folks make a deduction on their tax return for long-term care expenses? You know what? I think we're going to talk about that. We're going to talk about that for the next 6 to 7 minutes or so. So buckle up because we're going to have some fun. Remember, folks, if you like this video, make sure you give me a thumbs up. Also, make sure you subscribe to my YouTube channel where I send out all kinds of juicy content like this. My name is Charlie Gipple, and I'm the owner of CG Financial Group based out of beautiful Des Moines, Iowa, where I am an independent marketing organization for fine financial professionals like yourself. So enough of that. Let's get into this. Here is kind of the middle part of the 1040 and the meat of the 1040. By the way, the 1040 is the tax return. And here is the first part of the 1040. So never fear, we're not going to talk about that form specifically. We're going to summarize what that form does. And quite summarizingly, quite briefly, what it does is at the top, what is your total income? In the middle, what are your deductions? At the bottom, what is your tax liability? That is what the 1040 does. Now, it gets a little more complicated than that, right? And this is where the opportunities for you, the financial professional, lie. At the top, let's start with that. Total income. Total income. Total income is fed in information from various sources. Your W-2 that you got from your employer at the end of the year. Some of us don't get W-2s because we don't work for anybody other than ourselves. But if you do, you might be a W-2 employee, which means you get W-2. That feeds into that top box. What about if you own a certificate of deposit, for example? $100,000 in a certificate of deposit. On that Schedule B, there will be like 38 cents in interest, right? That feeds through to the 1040. And on that section of the 1040, I, the financial advisor, will be able to see that you have 38 cents in taxable income from that Schedule B. Let me talk about the schedules here before I go on much more about this. So you have the tax return, the 1040, but then you have all of these side calculations. One side calculation is what is your taxable interest and dividends? That side calculation is called the Schedule B, which then feeds into the 1040, as I just alluded to. What about capital gains and losses? Okay, Charlie owns a bunch of stocks over here. He has some that have been dogs, some that have been great. What is the net of all of that? That side calculation is the Schedule D. That feeds into the 1040, and you see that here as well. And by the way, so you know the opportunity with the Schedule B area, right? Hey, you have taxable interest. Number one, I can increase that interest with an annuity, possibly. And number two, I can make that disappear from that taxable column altogether because annuities are tax deferred. But again, there's the opportunity as well with capital gains and losses. Is your financial professional, man, the market is down this year and you are showing a capital gain here? Do you have any dogs that maybe you want to cash out to offset those capital gains in future years so that you're not getting taxed on a capital gain in a down year? Now, we probably won't see a lot of that this year because the market's been down severely, but I've seen that in previous years. Consumers that own a bunch of mutual funds in a down year, they may show a capital gains because the mutual fund company sold their stocks that were gaining and not as much of the stocks that were losing, passed through the capital lot or the capital gain to the consumer, even though altogether that consumer is down on their overall portfolio. But I digress there. So what you have is all these areas that are feeding into the 1040, which presents opportunities for you to analyze, right? One form, one big form that feeds into the 1040 is the Schedule 1. And the Schedule 1 has other forms, side calculations feeding into it, right? Such as the big one for me, the Schedule C. That's my business income. That feeds into the Schedule 1, and then that in turn feeds into the 1040. What about farmers? The Schedule F. Farmers that are profitable, which probably not as many this year as there have been in the past, fertilizer costs, all that good stuff, they will see a profit on their Schedule F that will feed into the Schedule 1, which then feeds into that total income section. Now, this is the cool part to the second part of Schedule 1, or this is the cool part, which is the second part of Schedule 1. And that is the adjustments from all of those income numbers that we just talked about there. Now, what's cool about these adjustments, what's cool about these deductions is they are happening above that thick black line. They're happening above the line. Why is above the line so cool versus below the line? A below the line deduction might be, say, interest on my mortgage. That is an itemized deduction, right? I'm not going to itemize my deductions, which means that below the line deduction doesn't mean anything to me. I'm going to take my standard deduction this year, which I'm going to explain why that is here in a bit. But my point is when it happens above the line, well, when you have a above the line deduction, regardless of what fork in the road you take down here, down below, do you take the left fork or do you take the right fork? Because you have to take one of those forks, you cannot take both. Regardless of which fork that you take, the above the line deductions, like what you see here in the second half of Schedule 1, you get to participate in those above the line deductions, regardless of which of those two tracks you take. Qualified charitable distributions, if you have RMDs that you have to take, required minimum distributions, what if instead you sent that amount to a qualified charity, directly to a charity? That impact happens above the line, which means whether you itemize or you don't itemize, you get the benefit of that. What about self-employed that are paying for long-term care insurance, for example? That is an above the line deduction, and it's not subject to any 7.5% of adjusted gross income that otherwise an individual would be subject to if that individual owned long-term care insurance and wanted to take that deduction. That's an itemized deduction. And again, they have to have health expenses of above 7.5% of adjusted gross income. So that is the importance of above the line deductions. That's the importance of the Schedule 1. That's the importance of the 1040. Two very important forms that you should get from your clients if you want to have a good tax conversation. Schedule 1 and the 1040. Those above the line deductions are beautiful. So above the line deductions are deductions for adjusted gross income. Below the line deductions are adjustments from adjusted gross income. Now, standard deductions. Tax Cuts and Jobs Act of 2017 roughly doubled the standard deduction. Now, if you're a couple age 65 and older, $28,700 is your standard deduction. That is usually the larger of these two red boxes. The left-hand side is usually larger than the itemized deductions. Itemized deductions being mortgage interest, real estate taxes, health expenses above 7.5% of your adjusted gross income, as I alluded to. The left-hand side, and I'm getting all excited here talking about taxes. The left-hand side, as a result of the Tax Cuts and Jobs Act, is usually the fork in the road that folks take, which means these below-the-line deductions, for the most part, don't really matter anymore. And by the way, many of these deductions, even the above-the-line deductions, depend on how large your adjusted gross income box is, or how small the adjusted gross income box. I'm referring to phase outs. Many phase outs rely on that adjusted gross income box. If it's too big, you're phased out of certain deductions. The child tax credit, for instance. Can you deduct your individual retirement account contribution, for example? Can you deduct that? That depends on how large your adjusted gross income box. That middle box there is probably the most important. The AGI box is probably the most important on the whole thing. And you helping your consumers shrink that down so they get all of these other tax deductions elsewhere that are subject to phase outs. That's very, very important, as well as we talked about, recognizing the opportunities with the Schedule D, with the Schedule B, et cetera, et cetera. One last thing, you go down the list, whether you're on the right-hand side or the left-hand side, tax credits. Tax credits are generally better than tax deductions or deductions from income. If you have a deduction from your income towards the top, let's say it's a $1,000 deduction from your income, you may have an ultimate tax benefit from that of $300. Conversely, if you have a tax credit of $1,000, your tax bill will be reduced by $1,000. So tax credits are generally better than tax deductions. I think that's everything, folks. Remember, if you like this video, give me a thumbs up. If you like this video, also subscribe to my channel so that you get juicy content like this sent out to you on almost a daily basis. Also, go to cgfinancialgroupllc.com and subscribe for ongoing emails where this is delivered straight to your inbox. Thank you, folks, and have a great day.